Hello everyone. In the last video, we talked about small farm investing as a growth investment strategy. Another way we can set up growth investing is to invest in initial public offerings. Initial public offerings can be considered as growth firms because the very reason these firms go into the market to raise fund is because they want to invest in some sort of project or grow the business. Therefore, in this learning objective, we discuss evidence pertaining to IPO Premium and IPO investing as a trading strategy. There is a whole lot of evidence that tends to show that the subscription price for initial public offering tend to be below the market price at which these shares are tradable at the end of their first day of trading. There's been a vast number of studies that looked at this issue in the United States. It's been shown that across the sample of 13,308 initial public offerings, the average first day return was 15.8%. This means if you bought every one of those 13,000 initial public offerings, you will on average earn a daily return of 15.8% because the market price closed above the price that you buy these stocks through the initial public offering. However, it should be noted that not every IPO trades at a premium at the end of its first day trading. About 50% of initial public offerings are overpriced, which means these ones close at a market price below the subscription price on the first trading day. There is some way that we might be able to predict which initial public offerings are going to be the ones that generate positive returns because IPOs that are oversubscribed typically shown to be more likely to be the initial public offering that have a positive return on the first day of trading. So investing in IPO is a short-term strategy that could be considered to have some merit to a growth investor. However, it's important to note that not all usual public offerings earn a positive first day return, and therefore it's important for investors to be diversified across IPOs. It should also be noted that performance of investing in IPOs is also time varying, so the IPO premium is on average higher when the general market is doing well. For example, during the bubble around the turn of the millennium, we saw a huge IPO premium, and this investment strategy performed very well as there was a huge rally in the market and lots of IPOs were issued during this time. Now, it's important to note that IPO investing is a short-term strategy. That is, to profit from IPOs, you do have to sell the stocks quite a short time period after listing. Because there is actually evidence that over the long run, that is 5 years post-IPO listing, many IPO tends to actually underperform. So while we have got a short-term positive overperformance, we may get long-run negative abnormal returns. Finally, as in every investment strategy that requires frequent turnover, this strategy is also going to incur transaction costs. So thinking about the IPO premium varies across time, we have put it on the screen. Here is the average IPO premium or the average one-day return generated by investing in this strategy across years from 1960 through the mid of 2000s. We can actually see clearly on the screen evidence of a very large IPO premium during the internet bubble. You can see these big buildings here. And we also can see some other periods through history where there are hot IPO markets, that is these periods where IPO premiums are very large positive and when a lot of IPOs were being issued. This result indicates the time-varying nature of IPOs where IPO premium is definitely not constant throughout the time. So as well as being diversified across IPOs, it may also be important that an IPO investor seeks to time the market or is diversified through time. So thinking about the performance of IPOs that was mentioned previously, that initial public offering tend to subsequently underperform over the long run. One's demonstration is the bar chart that we see on the screen. So we are looking here is the period after the first day, after the positive premium is experienced. So the question is, what does subsequent return perform? In this case, the blue bars represent the average return of the stock 1, 2, 3, 4, 5 years post IPO. for those stocks that list on the market, and red bar represents the average return in the subsequent 5 years for non-issuers. The key takeaway from this is that blue bar are lower than the red bars in each and every instances, over the 1 to 5 year post-IPO period. So we find that those shares that do initially list on the market subsequently underperform over 1 year to 5 year period. So this is a trading strategy that does involve a very frequent turnover because the shares have to be sold not long after the initial public offering. Now, there is a range of issues that we have confronted when we consider IPO investing. The most prominent of this issue is known as the winner curse. Academic studies argue that individual retail investors are not necessarily able to access all the initial public offerings. This is because the IPO generally works is that preference is given to priority clients or those to be either broker's client who does a lot of business with a broker, or maybe institutional investors who are able to buy big blocks of shares at one point in time. So, because priority is given to professional investors, many of the best performing IPOs will be fully subscribed before shares are actually available to retail investors. This means that the shares that are left over and available to retail investors are those that the professional investors have opted not to invest in. These tend to be the IPOs that have poor fundamentals and subsequently likely to be underperformed. That's why we get this name of winner curse, because as a retail investor, the times when you win, that is the IPOs you are actually able to subscribe to, tend to be cursed in the sense that these new IPOs that professional investors have elected not to buy. So with regard to retail investor, is there a particular category of IPOs that retail investors might be able to access and have equality in terms of their ability to access shares in that initial public offering? The answer is yes. There is one subset, and that is government IPOs. Over the last 25 years, the Australian government has privatized a large number of businesses, and one key feature of these government IPOs is that the initial public offering is set up in such a way that there is equal pro rata access to all investors. So individual retail investor will effectively have similar access as compared to institutional investors. Given this is a subset of initial public offering not affected by winner curse, that is, the retail investors often have just as good access to this initial offering as institutional investors, it might be important to ask how historically have government IPOs performed. On the screens, I have got a list of prominent government IPOs from the last 25 years. As you can see, Commonwealth Bank, NSW Government Insurance Office, Qantas, Telstra, TAP, Queensland, and so on. We can see that across these initial public offerings, all but one of them had a positive first day return, and the average one day return across all these government IPOs was 10.83%. So there is a strong evidence that there is an IPO premium for government IPOs as well. And as discussed earlier, for retail investors, this is probably the segment of the IPO market that can be best accessed. Last of all, some detriments of IPO investing. First of all, because not every initial public offering does generate a premium, it's important that investors undertake careful analysis of the prospects of the firm. This involves strong valuation skills and analysis of the financial statements that are included within the prospectus so that you can identify those particular stocks that have the best financial prospects. Since IPO investing is a short-term strategy, you will need to gauge the market mood and demand for each offering. As discussed earlier, there tend to be hot IPO markets where the average premium is higher, so investor will need to try to determine if they are currently in that place. We also spoke earlier that the IPOs that are most likely to earn a positive premium are those where there's a strong demand or oversubscription. So the investor will also benefit if they can gauge the demand for every offering. In many instances, and particularly where we are talking about government IPOs, investor may like to play the allotment game. That is when an initial public offering is oversubscribed, the investor will often receive a pro rata amount of shares compared to those which they have applied for. So if you want a certain amount of shares, often it is beneficial to actually apply for more shares than you actually want to purchase, with a view that in the case of oversubscription, we will be able to purchase the desired amount of shares. Also important to remember two possible drawbacks associated with initial public offering investing. One is the transaction cost, and the second one is, as discussed earlier, issues with winner curse, because the fact that retail investors often won't be able to access those initial public offerings that have the best prospects.